Hello, everyone. Welcome to another edition of Real Vision's The Archives. This week's interview is back from 2016, and it's a conversation between Raoul and Harry Markopolos, the famous fraud investigator. Harry is very well known for his work helping to bring down Bernie Madoff and his Ponzi scheme, and more recently he's been in the news for some work he did on GE. What I think is interesting in this interview is he talks about how he's looking at the big auditors as maybe his next targets. And considering what we've had happen this year with Wirecard and the way auditors really dropped the ball in keeping track of that fraud, and that's really just one of many frauds that have not been uncovered by auditors. There's many statistics that show that auditors are really the worst place to go if you're looking to catch a fraud. So I think it's a really timely piece, and as well, it's just a fascinating and exciting piece. Harry is a great communicator, and what he does is really one of a kind. So with all that being said, I hope you enjoy this interview with Harry Markopolos and Raoul.
Harry, fabulous to get you onto Real Vision here in the Cayman Islands. I think you're the only person in the Cayman Islands wearing a tie, but there we go.
Oh, thank you for having me.
Talk to me a bit about what you do.
I was a derivatives professional, managing billions in assets in Boston, and I came across Bernie Madoff, and that's how I got into the Madoff case. But I have other cases that I've done that you've probably heard of. I've done the foreign exchange cases, and so as a result of those cases and the settlements in those cases with various state attorney generals and the Department of Justice and the Securities and Exchange Commission, having enforcement actions there, the spreads in foreign X for investors are cut in half. So I'm saving probably, in fact, the SEC, I give the SEC credit for that. They save investors more every week than their budget is for the year.
Really?
Well, $5 trillion a day trades in the Forex.
Yeah.
The spreads for investors have been cut in half as a result of the foreign exchange cases. And so they're making investors money. And they don't even know it, but they are. So the SEC has done a good job there.
And so what are the other cases you've worked on?
I'm doing some large-size Ponzi schemes currently. I have a $500 million minimum on Ponzi schemes, so I tend to concentrate on the bigger ones. And for public company accounting frauds, my minimum there is about $5 billion US.
So how did you get into this to become a fraud investigator?
I realized that finance was bullshit and math is truth. And I just applied math and accounting proofs to things that look too good to be true. And when you look closely, everybody else assumes genius. I say bullshit until I can prove it. And until then, to me, it's fraud.
So the finance industry is got to be perfect for that because it's full of purported geniuses and there's a lot of money at stake. So I guess fraud is ever present.
My motto is assume fraud first until genius is proven. And I just use math and accounting techniques. And I want to see if it's really genius or if it's something else. Usually it's fraud. There's only one Apple, one Google. Everybody else, probably a fraudster.
So talk to me a bit about tell me through the Madoff story. How did you start? Why did you start thinking about this? And how did you go about proving it?
Madoff was one of my competitors, and he was using a strategy that was unworkable because he was really bad at portfolio construction mathematics. He was pretending to replicate the OEX Standard & Poor's 100 stock index, but he was doing it rather foolishly. He was saying he was only using 30 to 35 stocks to replicate that 100 stock basket, and a true derivatives professional would have never assumed the single stock company specific risk that Madoff did. He would have just neutralized that risk by investing in the index, in the appropriate market cap weights. He couldn't have...
Sorry for interrupting your video, but I have a very important message to share. At Real Vision, we pride ourselves on providing the very best in-depth expert analysis available to help you understand the complex world of finance, business, and the global economy. So if you like what you see on the Real Vision YouTube channel, that's just the tip of the iceberg. You should come to realvision.com and see how we're not leaving any stone unturned. From publishing more in-depth videos, live discussions, written reports, and our latest feature, The Exchange, where you get a chance to engage with experts, fellow subscribers, and learn from everyone's experience, which can't be wrapped in a video. It's an experience which you live and learn from. So if you go to the link in the description or go to realvision.com, it costs you just $1 to get a month's access to this incredible content. I don't think it's something you could afford to be without.
he would have just neutralized that risk by investing in the index, in the appropriate market cap weights. He couldn't have, Madoff had to be picking stocks because of the way he constructed his so-called replicating portfolio. He would have had to only pick stocks that went up or stayed the same but never went down. And I didn't think that was possible.
So you got this idea in your head. What do?
I sent our marketing guy, Frank Casey, he was our senior VP of marketing, you go down to New York, find out what this Madoff guy is doing. He comes back with a tear sheet, and in 5 minutes I knew it was bullshit. Am I allowed to say that on TV?
Of course you are. This is Real Vision.
Okay, good.
So you realise it's bullshit. So then what makes you then want to take this challenge on to get him prosecuted or tell the world about it when nobody wants to hear what you've got to say?
Well, he's stealing my clients. He's stealing the clients of every legitimate asset manager. His Sharpe ratios are in the high 2s, low 3s. And so everybody's investing in Bernie. And so there's no room for me because my returns are real. I can't run a Sharpe ratio like that. The market goes up and down, and my strategy will too. Well, Bernie, he only went up 45-degree angle. And when you see a 45-degree angle in finance, we don't have those in finance. Those are in textbooks from high school geometry and trigonometry. A 45-degree angle in finance means one thing: fraud.
Yeah, exactly right. So how long was that process of you starting to build the case against him? How did you start building the case, and then who did you present it to? How did that process all work?
Well, at first I presented it to my bosses. They wanted me to reverse engineer Madoff's strategy so we could offer it to our clients.
Obviously.
So I did. I looked at it. It took 5 minutes, and I said, looks like a Ponzi. Then I spent a few hours of modeling it. I said, oh, it's definitely a Ponzi. I told my bosses, we can do it. I reverse engineered it. It's easy. Bernie's offering 12% returns, and he's giving you 4% vol. We'll do 14% returns with 4.5% vol. We'll own the market for that Ponzi strategy. And they thought I was kidding, and they didn't listen to me. They said, well, he's smarter than you. He's a market maker. He has better math skills, so I had wounded pride. And I said, well, that son of a bitch, he's stealing everybody's clients. I got to stop this guy.
And your reputation as well now.
Yes, now my reputation's on the line. So I started working on it nights and weekends, and I recruited a team. So I had our marketing guy, Frank Casey. I had my other portfolio manager who worked for me, Neil Cello. And then we recruited a senior investigative journalist, Michael Okront. And we went after Madoff. And it took us about 9 years to no avail.
9 years?
We call that too dumb to quit in finance.
How could you, sorry, 9 years blew me apart. I didn't realize it was that long. So how could you have the conviction to keep going? And what happened in those 9 years? People just ignored you, or?
I went to the SEC for the first time in May 2000, and I probably went in with about a half a dozen red flags. But the SEC at that time was very dysfunctional. It was run by lawyers. It was over-lawyered. And of course, they didn't understand any financial math. They didn't know what derivatives were. And so my presentation quickly found its way into the circular file. They put it in the trash can, and it went nowhere. And I had one champion there who was a chartered financial analyst who had spent 25 years in the industry at the Boston Company and Fidelity, and his name was Ed Mannion. And Ed said, you got to come back in. We've got some new people. And the following year in 2001, I was back in there presenting again. Same result, very, very disappointing for both Ed Mannion and myself. And finally in 2005, he calls me back and says, we have a totally new team. These people will get it. You come in and meet them. And they actually did get it in Boston. I went into the Boston SEC, spent hours diagramming the concepts on a mark erase board and colors. And I knew not to use derivatives math or anything like that because these are lawyers. But I had very simple explanations for everything. And at the end of that meeting, they said, this is rather serious. If this was in Boston, we'd have multiple teams in there the next day tearing this place apart. Unfortunately, it's in New York, where we don't have such a good relationship. So we're going to investigate this, and we'll get back to you very shortly. And they did. A week later, I get a call from Mike Garrity in the Boston office. We found something very disturbing. We're not allowed to share it with you. This case, we're forwarding it to New York with an urgent recommendation. And that's where it died. The people in New York could have cared less. If they're getting something from Boston, there's a big rivalry between those two offices. It's like the Yankees and the Red Sox. And there's no way in New York was believing that a big case came to them from Boston that was any good. Wouldn't be possible. They would have kept it for themselves, which was not the case. And so they put probably their worst team on it, and they investigated Madoff, and they didn't find anything.
How could they not find anything?
Well, the exam team was convinced that Madoff was front-running, because that's what he was basically, that was his cover story. He's trading 5 to 10% of the daily stock exchange volume on the New York Stock Exchange. And he would wink, wink, wink when people would ask him, say, Bernie, your option strategy, we know you're not doing that. What are you really doing? He goes, well, I'm trading 5 to 10% of the daily stock exchange volume, wink, wink, wink. And I know that if my customers are selling big stocks, the S&P 500 is going to go down. And so I know it ahead of the market. Well, that doesn't make any sense. He only knows 5 to 10% in this hand. What he doesn't know is 90 to 95%. What's going to determine future price and direction? The 90 to 95% that Madoff knows nothing about. Simple math techniques will solve big fraud cases. And the people on Wall Street were not even capable of doing simple mathematics. All you had to do was do a T-chart, because the bad guys give you enough information to solve your case. You take what they say, put it in math terms, 5 to 10% is what he's saying, and does not equal, what, 90 to 95%. Just do a T-chart, and that will solve most of your cases. You can solve most of your big fraud cases on a cocktail napkin. And sometimes for the complex ones, you may have to use the backside of that cocktail napkin.
So New York then listened to you, and at what point did they start realizing, okay, he's not front running? So that was their premise, I guess. When did they start realizing something could be going on?
Well, they never did until he turned himself in. The New York SEC was very ineffective. It's not the best office for the Securities and Exchange Commission. There are far better regional offices. They have 11 offices, and I would rank the New York office down toward the bottom. If you look at who solves the big cases for securities fraud in New York, it's typically the New York Attorney General. It's the prosecutor, Preet Bharara, for the Southern District of New York. It's the Division of Financial Services, another New York State agency, or it's the Manhattan District Attorney. Those four. Number 5 position, Securities and Exchange Commission. They seem to run away from big cases in the New York region.
Why? Because that's where the bread and butter is?
It is. If you want to get a good job on Wall Street, you punch your ticket at the New York SEC, and then you go into industry, become a chief compliance officer, make a lot more money, or you just start defending the bad guys before your former buddies at the SEC in New York. And they tend to do small cases and build up their statistics, and they tend to run away from the big cases. It's a very poorly managed office. Where the other offices at the SEC, you do a big case, they love big cases at other places. They have some really great people at the SEC. They have phenomenal people in Washington. I'd say Boston's a strong office. Fort Worth is a strong office. They have some really good offices. San Francisco is a very good office. Los Angeles is pretty good itself. There are plenty of good offices at the SEC. But New York, it just seems to be falling down on the job. They seem to be asleep at the switch.
So then how did it all play out then? So talk me through the latter part of the story when it all came to light.
Nothing we did stopped Madoff. The authorities refused to listen. What stopped Madoff was the financial crisis, and no one trusted the banking system. And other hedge funds had gates, and other asset classes, for instance, the fixed income markets, were frozen. You couldn't get a bid on corporates. And so where are you going to find liquidity? They went to Madoff. There was no gate, and they went to him like an ATM and pulled their desperately needed cash out to stay afloat. And he saw his cash account at JP Morgan. He saw his checking account dwindling to the last few hundred million, and he turned himself in on December 11th, 2008.
If we talk about mathematics, it's almost improbable to be able to lose as much money as he did.
Well,
I mean, you have to be spectacularly bad.
It was about 65 billion notional losses, but the real money in was only maybe 20 billion, maybe 23 billion tops. The 65 billion is what people thought they had. That's what appeared on their statements in November 2008. Of course, those returns were phantom, illusory, they weren't real. And so 20 billion evaporated. And if you looked at who got hit the hardest, you'd have to say it would be the Swiss. Certainly in the US, we got hit pretty hard. I would say it hit about 11% of the feeder funds in the United States. In Switzerland, hit about 29%. It was like a nuclear bomb going off over Geneva. It's about 14 billion in wealth just evaporated in Geneva.
Wow.
So they were hit the hardest. I would say Europe was hit a lot harder than the US. But you only read about the case in the US and not in Europe because the European investors were never paying taxes. That was always undisclosed, hidden money, dirty money. That's the sport in Europe. It's tax evasion, not soccer.
Yeah.
And so they couldn't admit in Europe that they had these losses because they never declared the income, the money. And as a result, they were silent victims. Where in the US, the victims are very noisy. They immediately retained counsel and started suing the feeder funds, the banks, the service providers, anybody that got them involved with Madoff, they sued.
And how much did they recover?
The recovery is still ongoing. Here we are almost 8 years later, and the cases are winding down through the courts pretty slowly. I think they'll be over in another few years. But some investors will get 100 cents on a dollar, but they'll have waited 8 years for it.
Yeah.
Others who have got nothing. If you went into a feeder fund that wasn't solvent and didn't have any kind of insurance scheme behind it, you may get nothing. Others got their initial money back very quickly from the big European banks that sold Madoff. It was rather embarrassing for them, and so if you put in 10 million euro, they gave you 10 million euro back. They wouldn't give you your fake returns, but they gave you your initial euros back. So everybody's circumstances were different. Some people were wiped out and committed suicide. Others are making out okay. Others filed new tax returns because they were paying income tax in the US on fake returns, and they filed amended returns, and they got their income taxes back for the last few years, and that actually saved a lot of families.
Yeah, interesting. So do you think the system learned anything really from this? Do you think the SEC is better? Do you think we're going to come and talk about the auditing system in a minute. Did anybody learn anything?
The biggest beneficiary was the Securities and Exchange Commission. This case took them to their agency's all-time low. They were founded in 1934, and in 2009 they were the laughingstock. And they knew they needed to get better. And there's an old saying I had in school from my headmaster. When the going gets tough, the tough get going, and the SEC, to their credit, got going. I met with the chairman about a month after, 2 months after the fraud became public, and I said, you really need a whistleblower program. Because the way I came in, I was totally ignored. You have no way to collect all the intelligence from all these people coming into the SEC reporting frauds. You have 11 regional offices, and you have a headquarters in Washington. You have 12 different ways of dealing with whistleblowers, none of them the right way. And you need to incentivize integrity. And the Department of Justice has a program that pays 15 to 30%. And they get high-quality, multi-billion-dollar cases. And they're about 20, 25 times more effective than you are. And she said, well, Harry, we need to be 20, 25 times more effective. And so I showed her the statistics on whistleblowers, and she said, well, we're going to do this. And truer words were never spoken. We now have a whistleblower program, and the SEC is doing really good cases. The other thing the SEC did to reform itself was they didn't have enough finance people there. They had a bunch of attorneys. Well, attorneys are very smart people, but not at math. They went to law school for a reason, because they don't do well at math. They're very good at the English language. They're very good at rational thought and reasoning and logic, but math is not a strong suit for them. So they're not going to catch anybody on Wall Street. So they needed to have finance professionals, and they do. They have finance professionals that they never had working there before. They're getting people toward the end of their careers in their 50s. People have been laid off. They're not going to get reemployed in the industry. They have a valuable skill set, and they have a financial toolbox that's second to none up here. And now they work for the SEC, and they're subject matter experts, and they have experts for every niche in finance, something that didn't exist there before. And they're very aggressive about doing large cases for the most part. Other than the New York office, I think the other regional offices love big cases.
So New York still doesn't?
I think New York runs away from big cases. I think that they've always done that. I don't know what's going on in that office. They need a shakeup.
So let's talk about the audit process in general.
Madoff feeder funds were getting clean audit opinions from the big four accounting firms. They were saying that the trades took place as advertised, that the performance was as advertised, that the assets were there, when in fact Bernie stole every dime on day one. As soon as the money came in, it was stolen. And so he fooled all the accountants. And if you look at the history of accounting, name the big company-killing, multi-billion-dollar fraud schemes that were caught by the big four accounting firms. Go ahead, Raoul, name them.
I can't.
You can't, and there's a reason for that. There aren't any. Now, if I asked you, Raoul, name all the big multi-billion-dollar accounting frauds that the big four aided and abetted, we could be here all afternoon.
Yeah.
So the incentives are totally screwed up in the accounting industry. There's no way the company should be paying the audit fees. It should be the shareholders. It should be a fee. Every time you buy a share, a certain number of basis points should be allocated to audit fees, because the audit fees are currently way too low. Management brags about how low they've gotten the audit fees. So audits become a commodity. The people doing the audit, 80 to 90% of your contact hours are by somebody in their 20s. Well, who's going to catch fraudsters when you're in your 20s? The only way you're going to catch fraudsters is to have thinning hair, gray hair, or no hair. You have to have been around the block and been burned several times before you're able to catch fraudsters. And these young 20-somethings, the turnover rate there at the Big Four, the hours that these kids work, 25% turnover minimum a year. There's very little training that goes into a Big Four accountant. They have some training programs, but they carefully navigate their way around fraud. And the other thing they do is they don't do a lot of substantive testing because that's expensive. So what they do instead is they do analytical tests. They just run some numbers through algorithms that they have, and they say, well, that's our test. And then they do very little substantive testing. For instance, most of the accounting firms, they'll take 75 sample transactions, and that's what they audit. And it might be something very stupid the way they do it. It could be the 25 largest transactions of the company for that year. It could be the 25 newest and 25 something else. Well, many companies will have millions or tens of millions of transactions, and you're auditing 75, and you're saying that's statistically relevant? I say, bullshit, that's not relevant at all. And they say, well, we did the Sarbanes-Oxley testing, and they have great internal control, so 75 should be sufficient. Well, it's never sufficient. That's why they miss all the frauds.
I don't even think they even know how to audit some of these firms. You know, whoever audits banks, I mean, I have no idea whether they can figure out anything that the bank is doing.
Well, who trains the auditors? I would say it's the clients, because the auditors come in wet behind the ears. They've just passed their either chartered accountancy or CPA exams here in the States. They don't know much, and they're asking the clients, and the clients are providing the training, and that's never a good situation. And so they're working long hours. They may be working 70, 80 hours a week, so they're tired. They don't have time to understand what they're looking at. They haven't been trained. It's a recipe for disaster. And company management can pull a fast one on them, and they're not going to know because you're sending 20-somethings against master con men and con women in their 40s, 50s, 60s, and 70s. And you wonder why the 20-somethings come back defeated each and every time.
Exactly right. So you think the answer is, and it makes total sense to me, is we need to realign the interest in that business, I guess.
Shareholders should pay a fee every time they buy a share or purchase a bond. And it should go to an audit. It should fund the audit. And the auditors need to be very experienced. It needs to be career track. It can't be up or out. You want very good auditors. And you want to expand the substantive testing. And you want to have the depth and breadth of expertise in your audit staff so that they are familiar with banks or insurance companies or manufacturing companies. Whatever that industry is, they know every trick in the book. They've studied every fraud in that industry, and they can detect it readily. They need to be working for investors, and it really needs to be the investors controlling the audit process. It should not be the CPA profession. The Public Company Accounting Oversight Board, it's like an old boys network. It's a self-protective society. It's a self-regulatory organization. And personally, I have caught more fraud as one individual than the Big Four. They have hundreds of thousands of employees worldwide. How could I be catching more fraud than they? They're so bad they can't even catch colds, those auditors. They're just... It's a broken profession.
And who audits their audit process?
The Public Company Accounting Oversight Board. But guess what? The results are kept secret. They'll just say that this Big Four firm, 36% of the audits were deficient. But they don't name which audits. And they don't make them return the audit fees. And the auditors, the engagement partners don't even sign the audit. They're embarrassed to. They sign the firm's name. You need to have the auditors sign the audit report. So if that company blows up in a scandal, then that engagement partner should be out of the profession.
So it sounds like it's a pretty low-risk career to be an auditor.
It is. It's low risk, not particularly well paying on a per hour basis.
Yeah.
You know, those young kids coming out of school, they might be getting $55,000, $60,000 a year, US.
Yeah.
And they're being billed out. So that works out to, with the hours that they're working, they may be getting $20, $25 an hour. And they're getting billed out at $150 an hour. And it's basically a pyramid scheme, and you're paying the partners at the top. And the partners don't do any training, or very little. They're basically relationship managers, a glorified salesman and saleswoman. They don't spend a lot of time in the trenches motivating their audit staff and helping them detect fraud. That's not what happens. And so it is a broken profession. It needs a total redo.
So talking broken professions, I think the other thing you were talking about was the insurance industry. There's something that you're getting very interested in. Talk to me about that.
Insurance is a very close cousin to Ponzi schemes by companies that are run poorly.
Right.
The insurance industry is unregulated everywhere. In the United States, we have 50 state insurance commissions. I think 43 of them are politically appointed by the governor. 7 of those commissioners run for office. And it's a race to the bottom in regulation. If you have the easiest insurance regulations, you'll take in the most insurance fees because operating carriers will choose to domicile in your state and put their employees in your state, and you will take fees into your state treasury. So approximately of every dollar that comes in insurance fees from the industry, 7 cents gets used for regulation to fund the insurance commission. 93 cents goes to the general treasury. So it's a profit-making environment for the states, and it's a race to the bottom to see who can regulate the least. If you regulate the least, you're going to get the most insurance companies domiciled in your state. You're going to get the most insurance jobs. And so the gatekeepers are supposed to be the big 4 accountants, but we just went into how they're not the gatekeepers. The state insurance commission staff, their investigators are even more poorly trained than the big 4, if that's possible. And so they rely on the big 4, on the financial statements that are put together, along with the statutory financial statements that are filed in each state. And they basically run through some mathematical formulas and run some ratio tests and say, well, this company seems solvent. Then you have another gatekeeper that's also proven ineffective, and that would be the rating agencies. So if you can't get a job on Wall Street, and if you've graduated with a business degree, and no one else will hire you, who's the hiring authority of last resort? It's the rating agencies. It's for the kids that can't get jobs anywhere else. And so the gatekeepers are bad, and then you have the state insurance commissioners that are worse, and they're the low bid for talent. They pay the least. And so they catch no frauds. And so you have these insurance companies out there, and they're all putting their reinsurance offshore in the Caribbean. And we're saying the Caribbean's going to regulate the reinsurance market. Well, that's not going to happen. And you don't know what the cross-risk exposures are between insurance companies. So you don't know where the reinsurance really is. It's sort of like the swaps market.
It's exactly like the swaps
in
market.
2007, heading into the global financial crisis, and we saw how that worked out. All those hidden liabilities that were sitting in the Caribbean in these special investment vehicles, in these special purpose vehicles, in the SIVs and the SPIVs, they ended up coming back onto the bank's balance sheet and sinking them, resulting in a rescue. And in the insurance industry, we saw AIG needed a rescue. We saw the Hartford struggle, Lincoln Financial. If it hadn't been for the rescue programs run by the U.S. Treasury and the Federal Reserve, we would have numerous insurance companies go under. Well, the situation's only worse. Basically, the insurance industry is where the banking industry was in 2007.
So what's the catalyst then? How does this play out in terms of what's the issues going to get exposed, what's going to cause it, and what's the outcome of that?
I have some large insurance fraud cases that I'm going to make public in 2017. And they're going to be in the tens of billions of dollars each. And I'm hoping that will be the catalyst for reform, hopefully for some congressional hearings, and that we see national regulation of insurance, and we see them become Basel compliant, because there's a lot of assets and liabilities there. There's trillions in assets and liabilities there that are unregulated by anyone, and we don't know what the cross-risk exposures are. And so it's a recipe for a systemic disaster.
And how does that systemic disaster happen? What is the event? Is it what are we insuring here? Or is it the money that's the actual capital from the insurance policies that's got the systemic risk? Where's the risk?
The risk is in the negative interest rate environment is certainly a risk for the insurance companies that they may not be able to survive.
Yeah.
It's hard to survive on negative interest rates in that industry.
Yeah.
But there are also risks that you can't really manage, and it's the fat tail risk. So everybody knows what the mortality tables are in life insurance, and it's a bell curve. Mm-hmm. Well, what if you have a pandemic like SARS, or some kind of new flu pandemic, or some kind of Ebola virus that is not short-lived, it's long-lived, and your mortality tables are off? Well, that would kill the life insurers pretty quickly, much quicker than negative interest rates would.
Yeah.
You could have an earthquake that was far more severe than you thought. And you thought that maybe 8.8 on the Richter, 8.0 was what you thought was in your risk model, and you had a 9.5. And you didn't think 9.5 was possible. And all of a sudden, the West Coast just crumbles. And you find out that your reinsurers had too much earthquake risk that they were reinsuring. But you weren't measuring that before because you didn't know to measure it. There's no measurement of cross-risk exposures. And so the whole system collapses. It's a daisy chain, sort of like AIG. If you don't rescue AIG, it's a daisy chain of risk, collapse after collapse, and before you know it, your financial system is blown up.
And what about on the investment side? What happens if bond yields back up or something, or there's a sovereign default or some part of the investment side where it leaves them with a huge hole? Does that create problems, or is that just an investment loss? And
It can create severe problems because I don't know that the insurance companies are good at financial risk measurement. Actuaries are good at insurance risk measurement, but they've failed consistently when it comes to financial risk.
what about all that money they manage? Is that not regulated?
It's state by state.
Right.
You basically have low-paid civil servants at the state level. They don't know. There's no Basel-type regime in place. There's no national set of insurance regulations. There's no international body that regulates this industry. So it needs to become Basel-like.
Yeah.
And right now it's more Tower of Babel-like.
Is the concentration of risks out in the Caribbean, in Cayman and Bermuda and those other places where these reinsurance companies are, is that where the real risk is hidden?
I would also say it's in the States.
Right.
I would say there's a lot of captive reinsurance, captives in the U.S. that are competing, and I would say that probably in the islands you may be better at running captives in insurance than we are in the States. I know that the islands get a bad reputation, but it's not totally deserved. I think there's a race to the bottom in the States. There are states in the United States that are competing, and they don't have the ability to compete with the Caribbean necessarily. But I'd also say the Caribbean regulators are overmatched. That this industry is very powerful. It lobbies. It says we don't need any regulation.
Obviously.
And the banks did the same thing in 2007. And in 2009, they were begging for regulation and begging for bailouts.
So what happens if one of these big insurance companies goes under? What does that do? Who gets hurt in this equation?
The states have insurance guarantee funds, and they're funded by levies on the industry, on people's policies. You're paying some kind of a surcharge that goes into the state guarantee fund. So each policy is guaranteed usually for a maximum of $300,000. So let's say you are a mid-sized business and you have a $5 million in workman's comp policies. And unfortunately, one of your workers gets injured and is a quadriplegic for life. And he's going to need the entire $5 million for his or her health care. If the insurance company goes belly up, that policy will pay out to a maximum of $300,000. Well, now that employee can sue the business owner, who is suddenly uninsured, and the business can be sold and lost, bankrupting that individual who owned the company. And so a lot of small and mid-sized businesses will get hurt. I think the bigger sized companies can maybe manage, but it's the small and mid-sized businesses and the individuals that are relying on those policies to pay out.
It sounds a hell of a lot like the OTC derivative industry. Lots of private contracts. Nobody really knows where the risk lies. There's buckets of risk being shifted around, but somebody loses out in the end when the music stops.
It's going to take either a systemic collapse that requires government rescues, or we're going to need some spectacular cases to hit the headlines to lead to regulation. And I'm hoping it's the latter because that's the best for citizens and people that buy insurance.
But surely the price of insurance is going to go up as well.
It may not. It may go down. We don't know. If you have transparency, you're going to be able to look into the pricing and you'll be able to shop a little bit more efficiently, I think. And I think it could be like technology where the price goes down.
Yeah, it may rise initially, but after a while, as you say, as it opens up, becomes transparent, and a lot of this can be done automated, I guess, as well, in a more transparent way.
We know that the insurance companies are bad at risk management. And how do we know that? Well, AIG, Hartford, Lincoln National, and others from the global financial crisis. So we saw who was bad at managing risk, and yet we continue to trust them. Or at least for the investment banks, we've got them well regulated. We've got them recapitalized. Their return on equities are a lot lower. They're running a much less leveraged business model. And it seems things are better there. And so where's the risk left? It's in the insurance companies. And you have trillions in exposure there that is overseen by no one.
So what else are you looking at? Are you still seeing evidence of fraud? I mean, we're at a cycle top again, and usually in terms of equity markets at all-time highs, household net worth increasing because of it. So people become very sloppy. It's usually the classic time for fraud. When the business cycle rolls over, everything gets exposed. So are you seeing a lot of warning signs right now that there's a lot of shadier practices being taken place because money's been easy to get hold of?
I'd say there's a lot of public company accounting frauds, and I'm surprised at that. They're very easy to spot. For instance, level one asset, cash. Take a look at the statement uses of cash flow. If they don't add up, that's a big problem. If you can't add level one correctly, what are you doing with level 2 and 3? And I think a lot of companies have what I call level 4 assets on their books, fake assets. You can just create them out of thin air. And you're seeing certain industries are very prone to accounting frauds. And I would say the insurance industry is the industry I'm talking about. Things that don't add up. If you just look at the books and records, if you could read the financial statements, which of course Wall Street never does, and the mutual fund analysts don't either. I swear no one knows how to do basic forensic accounting anymore. If you end the year with a certain number, say your ending year cash for the prior year, should equal beginning year cash for the current year. Do we agree on that?
Yeah.
Oftentimes they don't. That's a problem. And you cannot hide an accounting fraud because you have so many balls up in the air. When you're making up the numbers, things are out of balance on your income statement and on your balance sheet. And they leave footprints the size of elephants. They're easy to track. And I don't think anybody is tracking the accounting frauds, and they're endemic in many industries. I'm not just insurance, but it's across the board. And I just don't have time to do them all, so I just raised my minimums. $5 billion is my current minimum for a public company accounting fraud. I can't touch them under that. I just let them go, because there's so many that are larger.
And you do these off your own back, or does people engage you to do this? How does that work? How do you make money out of this process?
The SEC will pay 10 to 30% of what they collect. So it takes 5 to 8 years for me to do a case and get paid on it. And I recruit a team. So I spread the risk. I find people to hunt Ponzi schemes. And so I have a group of individuals that loves doing Ponzi schemes. And they're basically in the hedge fund industry. And
that's where the Ponzi schemes are they?
Yes.
Yeah.
It's in the hedge fund industry.
Yeah.
So I get young men from that industry that have professional certifications that are really good at accounting and math, and they do it part-time, unbeknownst to their employers. So nights and weekends, they're Ponzi hunters. They're taking off work to meet with government special agents from the FBI, from postal inspectors. They're meeting with the Department of Justice, the federal prosecutors. They're meeting with the Securities and Exchange Commission, and they're presenting phenomenal Ponzi cases. And there's no shortage of them out there.
Big ones?
My current minimum on Ponzi's is about 500 million. I'm doing, most of mine are in the billions, multiple billions.
Wow.
No problem finding them. There's so many in the 20, 30, 40, 50 million range. And these young guys, I turn them over to them and I'll let them do them on their own. It's good training for them. And then I do a few big cases and train them on how to do those because it's fungible. If you can do a $5 billion case, you can do a $50 million case and vice versa. The steps are the same. Public company accounting, I've teamed up with some really good forensic accountants and we do those cases as well, and different teams.
So yeah, it's going to be some interesting times, I think. I think it feels like there's stuff to come. What about the private equity business, which is another secretive industry?
I have a buddy who I mentored, and he pretty much is the sole policeman on the private equity beat. And so he brings cases for fees because we know that private equity, those guys are really good at cheating their customers on fees. And they're also good at misrepresenting their performance. But it's only one guy. You need additional teams out there. There's people in the private equity industry that need to come out of the closet and start doing cases and turning in their peers or their employers. They need to start turning them into the Securities and Exchange Commission under the whistleblower programs. And once you do that, it's a giant FU to the industry. You're never going to work in the industry again. So you got to make it worth your while. It has to be a big case, big enough for you to retire in luxury. Otherwise, you wouldn't do the case.
I think it's good that you're doing this because the system's not doing it well enough. And we need a financial system you can trust because it's been proven time and time again we can't. We can't trust half the players in the industry. whether it's the auditors, or whether it's the regulators, or whether it's the firms themselves. And somebody needs to keep everybody honest here, because otherwise people just lose money. And it's always the people who can't afford to lose money who lose the most.
It is. It's unfortunate that the profession does not self-regulate well. And we've proven that. And so you need outside discipline. Fortunately, we have a much stronger Securities and Exchange Commission. We have a Commodities Futures Trading Commission. They have a whistleblower program too. But what we don't have is we don't have a big enough budget for white-collar crimes enforcement in the States, or anywhere else in the world for that matter. I would say that way less, in fact, than 1/2% of the total law enforcement budget is spent on white-collar.
And there's a big problem, and as the society is becoming very polarized, the 1% and the 99%, people still are not listening to the mantra of what people are saying is, nobody seems to be going to prison. And, I think that's a real issue as well. I mean, again, with just this massive fraud at Wells Fargo, everyone's untouched. Everyone walks away with $100 million bonuses and nobody goes to prison.
Oh, Wells Fargo. They laundered, sorry, not Wells Fargo, it was the Wachovia Bank. They laundered, almost $400 billion for the Latin American drug cartels. The bank made between $3 and $4 billion in profits. They paid $160 million in fines. No one went to jail. What message do you think the big banks got from that? Do more money laundering. It's a green light for money laundering.
Yeah, massive return.
You pay a few pennies on a dollar, and you don't even pay it from your bonus pool. It's paid from the shareholder accounts. So the shareholders pay the fines. You get to keep your bonuses. No one goes to jail. Do more money laundering. And that's the message that's out there to the big banks. We need to do more money laundering. And so it doesn't stop. And who launders the most money? It's not the Caymans. It's not the
here
British
is the
Virgin
most
Islands.
regulated place in the world for that.
New York and London.
Oh, of course.
That's who's laundering the money.
Yeah.
It's easy to point to the Caribbean. But every time you're pointing that one finger, saying it's the Caribbean, you're pointing 3 back at yourself. It's New York and London. Offshore is New York and London.
Yeah, absolutely right. Harry, thank you very much for your time. I think it was fascinating.
I hope you enjoyed this special episode of The Interview, the premier business and finance series in the world. For even more in-depth content and expert analysis, visit the membership link in the description and unlock a month's access for only $1. That dollar can change your life.